In this class, we will be using the triangle of fraud action that we considered, among other things, in the last class as a way of looking at how an organization can bring or introduce its intervention mechanisms and what are really the intervention mechanisms the organization should have. By intervention mechanisms, we are talking about the wall of intervention that will prevent the pre-fraud element or the pre-fraud situation to turn or materialize into post-fraud. At this level, it's still a pre-fraud at the level of the traditional fraud triangle that we considered. These are the situations that must occur before a fraud can even occur. But if this must not metamorphosize into an actual fraud, there must be a wall of intervention that prevents fraud. In between the pre-fraud and the post-fraud must be this wall we are talking about. We can situate this wall at the back of the post-fraud. It doesn't have any effect. The real duty of the wall of or intervention mechanism is to stop fraud. That's why we call it wall of intervention. Number one of such wall of such mechanism is internal control. Simply, internal control is a process or activities that ensure that what you want to get done is done. In a simple or layman language, internal control is a system or process that ensures that the objective you want to achieve, you are able to achieve it. The objective. So it's not just about fraud alone. It's a system or a process to make sure, that real objective the company is set out to achieve is achieved. Like, for example, how do you ensure your employees, they actually work for the hours they are paid for, not more or less? You can see now, you want to achieve that the control over your employee, that they don't just come to work by 8 and run away by 10 a.m. That is an internal control. That is why you see people signing register when they enter the organization. You see them signing register when they are exiting. It's a control so that they don't shortchange the organization of the man work hours that they are due to work. Another of such is the corporate governance. There must be a corporate governance instituted in the organization that forbids some things happening, that would deter fraud. The same thing applies to regulation. There must be reasonable regulation and policies and regulation that are just there. That's okay. You can easily identify somebody who is deviating from the regulation and is not playing by the books. If all these are not there, that means the wall is not there. Anybody can easily cross from the pre-fraud to the post-fraud. Then there are so many prevention techniques that must be put in place as well. So out of this, we are going to lay more emphasis for the purpose of this course and relevance to this course on the internal control. For instance, now, if in an organization where there must be the MD's approval on any payment that is above 1 million naira, that is a control. If another head, maybe the head of finance, must sign off on any payment that is above 500,000 naira, that is another level of control. Then, if, for instance, now, the head of department must be aware of any payment that is above 100,000 naira, then that is a control. They've calibrated it. When we talk about control, a good characteristics of a good control system is separation of power and duties. A single person can't end up in any way if you must prevent fraud from carrying out the chain of a particular transaction from the beginning to the end. If not, you've given him the control and the check, the power for the control and the personal check of his own of his own activities in a single hand. And in such a case, so the fraud is inevitable. In such a case, fraud is inevitable. Fraud will be inevitable. So what are we saying? We are saying internal control is a key intervention mechanism, is a key wall out of the walls of intervention that prevents the pre-fraud from materializing into post-fraud. So each businesses must choose the best internal control that fits into its objectives and the scale of his business. The internal control in system A or in organization A would definitely be different from the internal control system in organization B because of the level of their activities. For instance, Organization B might require electronic card reader for employees to enter the organization so that they know who is entering and who is not. The organization C or A can just be limited to cash register. Maybe they are just 5 and you can easily identify who is not around. Meanwhile, another organization can just be, they don't even have money for card reader and they are too big for, what's it called, for just maintaining staff register alone. They install CCTV that at the entry and at the exit point that shows clearly the time you are entering and the time you are exiting. So it depends on the objectives that you want to achieve. And the amount you will invest into your internal control as well is a function of what? The size of the organization and the size of fraud you are trying to prevent, as the case may be. Organizations must ensure that all other walls of all other components of this intervention mechanism must be in place as it applies to them. For instance, organization must ensures that it complies, that its staff complies with regulations, that it itself as an organization complies with regulation, talking about maybe filing for tax returns at the right time, not going against the laws of the land, because these are the things that even breed corruption among the employee. Maybe for instance, now you want your system to look better, and you are telling your accountant to make false journal entries. You want your financial statement to look better. You are already polluting if the accountant, even if he doesn't have the mind for what? For fraud in the first instance. So regulation is very, very, very key. Organizations themselves must follow the regulations. And when you see as a fraud examiner a red alert that their fundamental regulation sideline, that is an intentional flouting of the regulations of the laws of the country or the laws of the industry by an organization, you should know that there will definitely be bigger frauds hiding somewhere, corporate frauds hiding somewhere. And in such organization, if you look further, you will see massive employee fraud because their corporate governance is weak, they are not following regulations, and definitely for an organization that is flouting regulations, their internal control must have been what? Must have been compromised. So it works hand in hand. It all works hand in hand.